Okay, brilliant. We're recording and we're underway. Thanks to everyone for coming on today for Proactive Tax Planning 2021. Thanks for everyone in the chat who's confirmed that the audio is working fine. Do let me know at any point if the audio happens to drop off. And of course, if you do have any questions throughout the webinar today, please use that Q&A button, which is there and available on your Zoom platform. So let me get those slides moving. Yeah, I'm on slides. There we go. Got them moving. So today's presenters will be myself, Drew Flown. We've also got Simon Strawbridge, Christine Presedia, Anna Carter, and Mike Beer, who will introduce and get underway very shortly. So those of you who aren't familiar with MUNRO'S, we are the professional problem solvers, and we help Australians build $1 million plus businesses. We prepare tax returns, financial statements, due diligence reports, farm succession planning. We help in the cryptocurrency space and those startups who are raising seed capital and further expansion. And we have 74 5-star Google reviews. That slide just needs a little update, yeah, because we've got one through very recently from Travis. So thank you very much, Travis. It was great helping you out with your seed round. So these are part of these MUNRO webinars. They're really about imparting information knowledge to you so you can make prudent and informed decisions. So today we're all about your tax planning before the end of the year. What proactive steps can you take to minimise your tax and set yourself up for the longer term? And within that tax planning there, I think it's very important to note that the MUNRO'S way is working for you and certainly not the ATO. So we'll make sure that everything is legally and commercially possible and doing that in a way which minimises your tax. Okay, so the agenda today, we've got about 1 hour to run through quite a lot of content here. So we'll do our very best. We won't be able to have enough time to go into detail about everything, but hopefully it's sufficient enough information to get you understanding some of the key areas that are available to you, and then should you need some further advice, please reach out to us for that tailored advice for yourself. And on that, obviously the disclaimer is it's just general information today. We're not tailoring it to your own individual circumstances, so you can only take it as a guide, and should you need some tailored advice, please reach out to us. Okay, so yes, I was just going to pop up the poll quite quickly. There we go, launch the poll. Just get a sort of a feeling amongst our attendees today here. What tax planning should we be focusing on? Business, farming, cryptocurrencies, superannuation, personal. So if you just wouldn't mind just quickly selecting an option there, I'll leave it open for a couple more moments and I'll just end the polling very quickly, share the results. So we've got about 22% on the business side, a lot to do with the cryptocurrency, which isn't too surprising because how popular that is at the moment, some superannuation there. So let me just finish sharing those results and continuing on. Come on, slides, here we go. All right, brilliant. So I'm going to hand you over to Simon Strawbridge, who's going to fire away, take us away on the budget updates. There you go, Simon. The camera's right here.
Okay. Thanks, Drew. Right, well, yeah, I've got the budget announcement, and I had to read through that. Really, there wasn't too many new initiatives announced in there, really expanding upon some of the initiatives they'd already announced during the COVID initiatives and measures that they announced. So it was probably the main one that really got us quite excited is the full expensing of depreciables. So that's really going to have a pretty good impact upon quite a lot of taxpayers, particularly if you're in the business and you've got plant equipment and that sort of thing. Even if you're carrying on a cryptocurrency business, I know there's quite a few people keen on that. as well as just a general run-of-the-mill businesses, farmers and manufacturing businesses and the like around town. So originally the full expensing of depreciables was due to finish on the 30th of June 2022, but they've extended that out to 30th of June 23. So that's quite good because it gives us a lot more time to take advantage of the measures. And one thing that comes to mind is that I know a lot of businesses are struggling to get equipment in. There does seem to be some shortages on some key items of plant equipment that people are keen to invest in. So all of that, the planned incentives are all part of the government providing incentives for business to invest in their capital equipment and plans, so hopefully grow the economy. So they're giving some, they really are significant tax incentives. So businesses with an aggregated annual turnover up to $5 billion, so that's safely going to cover all the businesses here at the MUNRO'S that we assist. They are going to be able to claim the full cost of any new depreciating assets acquired from 6th of October 2020 and first used or installed ready for use by 30th of June 23. I'll come back to that with the installed and ready for use. So businesses with an aggregated turnover of less than 50 million, which once again is going to apply to most of the clients that MUNRO'S advise on here. Temporary full expensing also applies to the business portion of eligible second-hand assets. So it has to be new, but now second-hand as well. So that's quite good as well. So for most of the businesses we advise here, we're going to be doing quite a bit of work in this area. Now, one of the key points to note is that you do need to have the item installed and ready for use in order to claim the deduction. So it's not enough just to order it and pay for it. You actually need to get it, take delivery and have it ready for use in your business. So now another question that does come up a fair bit is, of course, car purchases. There is a car cost limit. Car is a sort of vehicle that's designed primarily to carry passengers. So the cost limit is $59,136. So if you're going to run out and buy a car, a Toyota Land Cruiser Sahara, a couple $100 grand, might not get much change. You still can only claim $59,136 that goes in as a deduction. And that also depends on the business use. It doesn't necessarily mean you can claim 100% if you're not using that vehicle, car 100% for business, and it's only the business percentage that you can claim. So just watch out for that one. You can, if you wish, opt to temporarily opt out of the temporary expensing on an income year. So you may not necessarily want to claim the cost of that plant equipment. Maybe it's going to create too much of a deduction for you. So you can opt out on an asset by asset basis if you're not in the simplified depreciation system. Most of our clients are in the simplified depreciation system. So if you're a small business that chooses to use the simplified depreciation rules, and we've got quite a few clients that do that, that's for the general pools and all that sort of stuff. And that applies to businesses with a turnover of up to 10 mil. You can apply the temporary full expensing rules with some modifications. And one of the real interesting and once again exciting things for us is that it also means you can deduct the balance of your general pool as well. So up until 30th of June 2020, where we've been doing everyone's tax returns, if your pool balance was less than 150 grand, we would have said, yeah, oh, I can claim the balance of that. That's all good. So that's the old depreciation, what you haven't already claimed. So that was really good. But now, effectively, with this full expensing, it doesn't really matter what your pool balance is if you're in the simplified rules, turnover less than 10 million. If the pool balance is 500 grand, 800 grand, you can claim 100% of that tax deduction this year. So that really does open up some excellent tax planning opportunities. So we'll be doing a lot of work over the next month with our business clients, trying to work out how we can take advantage of these rules, coming up to tax estimate time. And it may well be that people may, like a farmer, for instance, may end up using farm management deposits, cashing them in to offset some deductions and stuff like that. So that's going to create some really good cash flow incentives for them.
Simon, if you may just butt in there, because you've got a question that's come through from Sophie, which is, do commercial landlords get this deduction?
No, unfortunately, Sophie, you have to be carrying on a business in order to get all these depreciation deductions. So you have to be carrying on a business. Commercial landlords wouldn't be carrying on a business. That's a rental property, so it won't apply to residential, commercial rents and all that sort of thing. Good question. Have to be carrying on a business, unfortunately.
I'd say there is a little bit of asterisk on that. There is occasionally the time where a commercial landlord is carrying on a business.
Well, we have successfully applied to the ATO to get a classification that a commercial landlord has been carrying on the business of renting property. That's probably not going to cover that in this presentation today, Drew, but yes, we have been successful in doing that with commercial landlords, but it's a bit unusual. You really do need to be carrying on a major commercial operation. Okay, if that applies to you, we're certainly more than happy to have a look at it. Yeah. So plenty of tax planning opportunities there. One of the interesting ones is you might even be financing assets. So let's say you're a winery and you want to improve your bottling line or whatever. You want to go and spend $500,000 or whatever. You might actually choose to finance that as well. So you're not actually out of the cash, but you get to claim 100% of the expense as well. So that's going to create some really significant cash flow advantages as well by having that tax deduction. There's also a lockout rule previously where small businesses could elect to not to drop out of the simplified tax system. So what they've done, they've said, oh, well, if you've opted that because you have to stay out for 5 years, they've said, oh, forget about that. You can still take advantage of the temporary expensing of new and second-hand equipment that you buy this year. So that's a pretty good option as well. So we'll be looking at all those sort of scenarios for our clients over the next month or two. So just make sure you can sort of get in touch with us pretty early so we can do your planning and give you plenty of time. And now another provision that they announced, and this is quite good too. We're quite excited about this as well, as much as accountants can get excited. We've got the company carryback loss rule. So if you've got a company, you're carrying a business in a company structure and your turnover is less than $5 billion, most clients here, then you can elect to carry back your tax losses up until the 2023 financial year. They've extended it by a year. So essentially that means that if you've got a loss this year, you've made a profit in a prior year, you can take that loss back and effectively get a refund of the tax that you might have paid in prior years. So that's a really good incentive. And of course, if you mix it up with these plant and equipment purchases this year, it's a double whammy. You might, you're going to get extra tax deductions this year, might push you into a loss. Effectively, you're going to get a tax refund from the prior year where you might have paid some tax from 2019 onwards. So that's a real good incentive as well. We'll be doing quite a bit of work on there for our company clients carrying on business there. They announced a few bits and pieces about effective life for intangible assets from 1st of July 23. Effectively, you can pick your own effective life, but I'm not going to go into that now because the legislation's still going to come out and we'll update everybody when that finally comes out. Expanding compulsory super to more employees. So currently, this is for only our business clients and employed people. If you're paying super for your employees, if they're 18 years or over and are paid $450 or more in a calendar month, you had to pay 9.5% super. If they're under 18 years old and being paid $450 or more and work for more than 30 hours a week, so that's what you have to pay your super for. So essentially, what's happening now is that that $450 income threshold's being scrapped, so effective from the first financial year after Royal Assent. So I don't know when they're going to get Royal Assent for this, but anyway, we'll keep you updated when that's actually going to apply from. But what it does do, it effectively brings in all those part-timers and casuals that you might have paid a few bucks to each month. That's going to bring them into the superannuation net. And if you haven't really already got or using some sort of payroll software to pay and record your super and your wages and the STP payroll and so, well, then it's really time that you need to get that updated now. And here at MUNRO'S, we've got some really effective and cost-effective and simple solutions to deal with that. So please get hold of us if you are paying employees. There's also a quick update on the individual tax residency rules. So what they're going to try and do there is simplify them. And we've done a lot of work in this area. It's really about time. The legislation that they've got in there now is like dates back 80 years sort of thing. It's really old definitions and how to work out whether you're a tax resident of Australia or overseas. It's really different. It's a huge amount of case law, a lot of arguments going on between the taxpayer and the ATO in terms of whether you are a resident or not of Australia. So what they're going to do, they're going to modernise it because at the end of the day, we are a very mobile workforce nowadays, a lot more people working overseas and travelling around. So they're just going to replace the residency rules with just a clear look. If you're here more than half the year of income, you're going to be a resident in Australia. And then there's going to be some other, that's going to be the primary test. If you don't quite meet that test, then there'll be some other secondary tests to have a look at. So we'll wait for those criteria to come through and the legislation, and then we'll report separately on that one as well. But anyway, that was it's about time they did that, I reckon. One of the final thing I was going to talk about is a goodbye to the work test, and I'm just going to put in a inverted commas sort of goodbye to the work test. So currently, if you're an individual 67 to 74, you can make voluntary contributions, concessional and non-concessional, to your super, self-managed or industry fund, or for yourself if you satisfy the work test. Now, the work test is basically, and if anyone's in that age group, we would have already spoken to you about this and worked with you. But you have to work 40 hours in a 30-day period in the relevant income year in order to make contributions to superannuation. And we've come up with all sorts of initiatives and advice around this area and ensuring people are gainfully employed in order to satisfy their contribution. So what's happening now, that work test is going to be repealed for voluntary non-concessional contributions. So that's money that you're putting in, you're not claiming a tax deduction for, and also salary sacrifice contributions into superannuation for those aged 67 to 74. Importantly, it doesn't cover self-funded concessional deductible contributions. So you've just got to watch out for that. And that measure is expected to commence on 1st of July 2022. So it's a fair way away. So we'll wait for the legislation to come through on that. But you're not really going to be able to take advantage of that for the next 12 months. So if you are in that age group, you've still got to go to work for 40 hours in a 30-day period at some stage during the year. And I think Christine or someone will be covering that a bit later. But you still got to work a little bit in order to get those contributions in. All right, well, that was me done, Drew. That's my any questions come up, or can I?
Excellent. You're all good, Simon. No further questions for yourself. So fantastic. Thanks for that update there. Thank you, Simon, on the budget updates. Who would have thought tax law is getting more complex, not simplified?
Yeah, it's all good. But we are very excited about the planning opportunities, particularly around depreciables. So reach out to us over the next month and look at that.
Yeah, spot on, Simon. Thank you very much. Okay, so coming up now is Christine. Christine's going to run us through tax planning opportunities for businesses and the longer-term tax planning. So let me just spotlight your video, Christine. You're on screen.
Hello.
You go.
Hi, everybody. My name is Christine. For those of you who don't know me, okay. If your business still do not have enough deductions from the depreciation that Simon talked about earlier, I'm going to be covering that. If you need extra deductions this financial year, then you can do it by incurring employee bonuses. So to incur the employee bonuses, it doesn't mean you've got to have it paid before the 30th of June. So long as you commit to the payment of the bonus, have the amount quantified and authorized to be paid, it can be claimed as deduction in the current financial year. Good practice, obviously, you've got to have it noted and recorded perhaps by a resolution or meeting, minutes of meetings. And to make sure that the deduction is not denied by the tax office, please make sure that you comply with the withholding requirement on bonuses paid. And also superannuation guarantee is mostly paid on those bonuses, apart from bonus in respect of overtime. The other deduction can be claimed from payments to compulsory superannuation before 30th of June, but please note that not only paying the super fund before 30th of June, but the payment must be received by the employee superannuation fund before 30th of June for this to be deductible in the current financial year. So if you're making payments to the industry fund, please ensure that you leave sufficient time, perhaps 2 weeks before the end of the financial year, to allow them to receive and process your payments. And the other way to get deduction in the current financial year is to write off some bad debts. this bad debt's only applicable if your accounts on an accrual basis, not cash basis. So if you previously recorded the debt as assessable income, then you can write it off before 30th of June. So you've got to review your debtors and consider it as debt and write it off. Before that must be before 30th of June, not after. And it's good practice, obviously, to have it noted and update your records accordingly. And you can also, for businesses with aggregated turnover of below $50 million, you can claim immediate deduction from certain prepayments. It can be prepaying interest, insurance, rent, subscription, advertisements. For it to be deductible, the expenditure must be incurred before 30th of June. And then the eligible service period is for not more than 12 months, and it must end before 30th of June 2022, so the end of the following income year. And you can actually play around with the terms of your supplies as well, actually, for this, because incurred doesn't mean you have to have it paid before 30th of June. So long as you incur means you've got a tax invoice, have it dated on or before 30th of June, you can actually claim it as your deduction in the current financial year. So if your supplier allows you an extended payment terms, perhaps fertilizer company allow you to pay probably around harvest, then you can order and have it locked in an invoice before 30th of June, and you can claim it this financial year. So the next slide, thank you, Drew. I need to talk about long-term planning. The use of trust and bucket company to be considered as well. Say if your family trust has got your trading or investment trust actually have got a lot of income in the current financial year or future years, and then probably the family members that you normally distribute income to have got a higher tax bracket, perhaps 30, 32.5, 37 or 45% tax bracket. You might consider using bucket company to limit the tax that you're paying on the income of the family trust. As you know, as some of you might know, the company tax rate is pretty generous. Actually, it's 30 cents in the dollar flat rate. Or even if your company has got some sort of business activity or what's called a base rate entity, the tax rate is even lower at 25 cents in the dollar from next financial year. With the difference in the tax rate, obviously you've got to be mindful of the ATO's Division 7A requirements, which is pretty strict, unfortunately. So if a family trust is making distributions about the company, then you have to physically pay that distribution across to the company. And if you don't do that within a certain time frame, you've got to put it into a complying loan agreement or a sub-trust arrangement. So tax savings, yes, but then it means it's a more complex taxation affair, and you need to get the right advice for this for sure. And also, we mentioned there about the individual tax rate being lowered from the 2025 financial year. The proposed change is to abolish the 37% tax bracket completely and widening the 30% tax bracket from $45,000 to taxpayers earning 200 grand, with the highest tax bracket kicking in from 200 grand onwards. So combining all that, substantial trust income, use of company, and then the change in the individual tax rates in the next couple of years, there might be some planning opportunities for those of you who are planning to retire in a few years' time, or having minor children turning 18 around that time. Basically, you might want to distribute those income now to a company to get the lower tax threshold. And when the time is right in the future, you might want to declare some dividends to the shareholders, which might be another family trust, and have the income distributed to the individual beneficiaries at your own pace. And you might be able to limit the taxation at the individual level, and perhaps even claiming some of the franking credits back for the tax that the company previously paid. The next one is restructuring. So you've got to ask the question over long, in the long-term question, basically. Are you investing and trading in the right structure? So from our experience, a couple of things that trigger restructuring, obviously tax minimization, can you actually share the income around between you, your family members, spouse, or the bucket company that I talked about earlier? And also whether you or your structure can access the capital gains tax general discount or the small business concession. And the other trigger point can be simplifying your personal, business and taxation affair to suit your retirement and estate planning goals. It can also be used to achieve your asset protection plan. Say, for example, if you're trading as a sole trader, obviously you might be exposing your personal assets against creditors' claim compared to if you are trading inside a company. The other trigger can be business expansion or having employees and external parties to be part of your business or investment pool. And also, say if you're planning to exit the business in a few years' time, certain structure may be more attractive to potential buyers and perhaps the industry that you're in. Obviously, with all of these restructuring, we're mindful of not triggering any taxation points, whether that be the ATO's capital gains or general taxation on, say, trading stock, plant and equipment, and also to make sure that you're not triggering any of the Office of State Revenues transfer duty. The next one is superannuation and SMSF, holding alternative investments. Income inside the superannuation fund is taxed super professionally, I reckon. It's a 15% flat rate in dollar, and certain capital gains is taxed at 10%. And if you're on retirement phase, all the investment income and capital gains potentially taxed at 0 rate, basically. So depending on your, again, personal and family situation, whether you're close to retirement, you're debt free, or you don't have any more school fees to pay, you might want to build up your superannuation balance. And at the same time, you probably can limit your tax by making contributions along the way. And then super fund can hold various different kind of assets. It can be real property, it can be farmlands, commercial properties, which can be leased back to your related entities, normal residential properties, obviously, and all these depending on the assets, they can be transferred across from you, can be transferred or contributed from yourself to the superannuation fund, or acquired using the funds inside the SMSFs. Apart from that, super fund can hold gold and bitcoins, and because of the concessional tax arrangement there, actually. So if you reckon certain assets will grow in value, say like bitcoins, or if you believe that certain shares will grow over the next couple of years, then you might want to hold these sort of assets within the super fund, because in the future the capital gains will be taxed at 10% or perhaps 0 if you are at retirement phase at that time. But obviously, all these, you're going to be mindful that the ATO has got very strict investment requirements for assets being held in self-managed superannuation fund. The next one is estate and succession planning and your will. So this is a very, very broad topic, and I can talk about this for a few hours. Okay, I reckon the best starting point is to look at your assets. What assets have you got? Whether that be cash, term deposits, your shareholdings, your superannuation balances, your real properties. What farmlands have you got? Commercial properties, investment properties, and your main residence as well, not to forget. And you've also, it's also worthwhile noting when you acquired these assets. Were they acquired before the introduction of capital gains tax, September 1985, or were they acquired after? And also, who owns these assets? Is it in your name only, or in your name and your spouse? And for like business real properties, are they held as tenants in common or jointly held? Or are they owned by you as trustee for your family trust? Or is it in a partnership or company or your self-managed superannuation fund? So it's good to list all these assets, the acquisition dates, and who actually owns these assets. And the next, because some of these assets actually will not form part of the estate. And the next question that you're going to ask yourself, who will be getting all these assets? Are they going to minor beneficiaries, your children below 18? Or are they going to adult beneficiaries? Are they married with children? Are they living overseas? Are they going to be continuing with your family business, or there are children who will not be continuing the family business? What are their personal circumstances? Are they gamblers, big spenders? Do they have disabilities? Are they drug addict? Or what's the marriage life like? Are they smooth sailing, or they've got some rocky patches there along the way? So, and also the next consideration is to ask yourself and us, I reckon, if you can or should some assets be gifted or restructured during your lifetime. It might give you some sort of tax benefits by doing so during your lifetime, and also to achieve your family succession plan, balance things out perhaps between your farming child and non-farming children or child, and certain things probably should be transferred during your lifetime, because if you believe that your estate will be contested in the future, or if you've got blended families, things like that should be considered. So all these factors is crucial in drafting a tax effective will. And other roles that you should consider is the executor, the person or the persons who will manage your estate. And so also if you've got minor children, you've got to consider who shall be the guardian of your minor children. And also it's very wise, as things change, your investments and your personal circumstances, do review your will every couple of years, perhaps 3 to 5 years, I reckon. So that's it for me.
Excellent. Thank you very much, Christine there.
Thanks, Drew.
I think that with the estates and succession planning that we're going to have to do an own independent webinar at some stage. As you mentioned,
Yep.
we can talk about that
Yes.
for well in excess of an hour probably.
Yes,
There's a lot to go through there.
Definitely.
So thanks very much, Christine. We did have a question come through during that, but we'll address that during the Q&A section.
No worries.
So we're going to be joined by Adam momentarily, just while he's getting ready. I just wanted to mention that some action that you might want to take come July and possibly prepare for this during June is to upgrade your bookkeeping system, because bookkeeping systems, they get better and better every single year. New software comes out, helps with the automation, helps simplify things, reduce the amount of stress. So if you haven't updated your bookkeeping system for a while, you may want to consider that, and just reach out to us and we can assist with that process. Okay, Adam, I'm just going to spotlight your video and you can fire away on the farming.
All right, g'day everyone. So I'll run you through some of the key concessions and considerations when tax planning for the primary producers. So I'll preface the discussion just by mentioning that MUNRO'S as a firm has nearly 50 years experience assisting primary production businesses. So this dates back to the inception of the firm in the early 70s. So, we've assisted primary production clients with a vast suite of services, and tax planning is certainly one of the key ones. So for those who are unaware, primary production, that basically includes businesses that are operating a plant or animal cultivation business. So this includes stuff like grain harvesting and livestock breeding. Also includes fishing and pearling and tree farming or felling. So I'll start with primary production averaging. So whilst this isn't necessarily a major tax planning tool in itself, it's definitely very important in understanding the impact this might have on your tax return. I'll just mention that it's not compulsory, but it is definitely a useful concession. So the purpose of the system is to even out income and associated tax payable over a maximum period of 5 years in an effort to equalise your tax implications with, say, taxpayers on a much more stable level of income. So any offset or additional amount of tax payable is calculated with it's quite a complex algorithm and depends on your average income and your basic taxable income. So broadly, where your average income over that period up to 5 years is less than your basic taxable income for that year, you're likely to receive an averaging offset, so that'll reduce your tax payable. On the other hand, where your averaging income is more than your basic taxable income, you're likely to be paying a little bit of extra tax, so this is known as complementary tax. So the reason why this is a consideration from a tax planning perspective is that the offset may have an impact on the way you choose to distribute your profits from the business. And it's also worth mentioning that there's not a hell of a lot of control that we can have over the impact of the averaging. But that leads me on to farm management deposits and withdrawals. So essentially, this is another form of income averaging, except you have a bit more control year to year than the averaging offset. So the effect of the scheme is to shift income from good years to bad years due to seasonal fluctuations, which are obviously very common in primary production industries. So any deposits made to an eligible farm management deposit can be claimed as a deduction to the extent of the primary production income for that year. Conversely, when that farm management deposit subsequently withdrawn, this will be assessable income. Rest assured, though, that any FMDs that aren't claimed as a deduction won't be assessed upon withdrawal. So there are eligibility requirements for a deduction to be claimed. Some of these include that any other non-primary production income in your tax return must be less than 100 grand, and that a primary production business is actually being carried on. So where a primary production business is ceased, this may result in a deemed withdrawal, and subsequently that will become assessable in tax return. There is a limit to the total balance of your farm management deposits, and that's currently at $800,000. This forms a crucial part of tax planning for farmers, as it's important to consider where there's an opportunity to defer taxable income from a good year, maybe to possibly a year it's not quite as good. And it's also important that where you do have those existing farm management deposits, you need to consider the impact of any potential subsequent withdrawals. Consider whether it might be a better option to roll that forward to the following financial year. So timing of any withdrawals is definitely crucial, and that's where tax planning is definitely very important. So moving on to some of the upfront deductions available to primary producers. So as Simon discussed, most asset purchases are going to be covered under the temporary full expensing, although this does exclude some primary production assets unless you're applying the simplified depreciation rules. So the good news is, though, current legislation still allows an immediate deduction for these primary production assets. So some of these assets include water facilities, so that's plant or structural improvements that's primarily or reasonably incidental to the purpose of conserving or conveying water. Also included is fencing, so that's an enclosure or barrier around a field or a paddock. And the final one is fodder storage. So this is the construction, manufacture, installation or acquisition of an asset used primarily to store fodder. So typical examples of those sorts of assets are hay sheds, silos and grain bins. On top of that, there's also land care expenditure. So land care operations include eradicating or exterminating pests, eradicating or exterminating detrimental plant growth, preventing land degradation, drainage works to control salinity or assist in drainage control, and constructing a levee or similar type of improvements. So the reason why I'm bringing up these primary production asset purchases and land care expenses is if you've had a good year, it might be an appropriate time to bring forward the incurrence of some of these expenses prior to 30 June to make sure it gets included within that particular year. So if there's a particular primary production asset you've been considering for a while, or you have a dam that's well overdue for a good clean out, now might be the time, depending on your circumstances, of course. So it is very, very important to note that some of these key concessions are only available to certain entities. So in particular, looking at the primary production averaging offset and farm management deposits, you can only access these concessions as an individual. So that does include partners in partnerships and beneficiaries in a trust that's operating a primary production business. So Of course, that excludes companies. So if you're operating a primary production in a company, it might limit some of the available tax planning opportunities. On top of that, we know primary production businesses, obviously income can fluctuate a fair bit from year to year. So there might be some years where you've operated at a tax loss. These tax losses might be trapped in certain structures, so that includes a trust and a company. So quite often we see partnerships in primary production operations in order to potentially offset some of those losses against off-farm income. So that might include income from investments or salary and wages from any jobs that are done on the side. That's of course subject to the non-commercial loss rules. So some other benefits of having the right structure in place is that you can obviously have asset protection. Value of some of these farming properties is pretty important, but also income splitting opportunities, which can be achieved through different structures, which comes in very handy at tax planning time. So the ideal structure for you will obviously depend on your circumstances and should be tailored accordingly. But if you think there's an opportunity to improve your structure or just want to have a chat about your current structure, definitely reach out and we can help out in that department.
Thanks very much, Adam. That was fantastic advice there. And I think everyone needs to wish Adam good luck over the next couple of weeks. He's getting married and then he's moving house. So I don't know which one's more challenging. So yeah, best of luck, Adam, and congratulations. So I'm going to pass over now to Mike. Mike's going to run us through superannuation and the tax planning opportunities there. Off you go, Mike.
Thanks, Drew, and evening all. So I'm starting off this tonight with deductible super contributions. So this is really using your 25 grand per annum concessional contribution limit. So you might have the situation whereby your employer is contributing, say, 15 grand super on your salary, but you might say, okay, well, I want to get a bit of an extra deduction this year, so I'll contribute 10 grand as a member concessional contribution into your super fund, and then you can claim that as a personal tax deduction. So what you're trying to do there is get a bit of arbitrage in terms of, say, if you're in the 47% tax bracket, including Medicare, and your super fund's only paying 15% on those contributions, and basically you've got a 32 cent tax saving for each dollar of contribution that you contribute within your deductible dollar limit. So obviously you've got to be careful of such things as, you know, say you're a high income earner. So there's division 293, the high income earner super tax. So what that means that if your income plus your super contributions exceeds 250,000, then you're going to be slugged for an extra 15% on your tax on your concessional contribution. So again, that arbitrage is not quite as good as what you originally perhaps thought it might be. Also, you need to be below 67. As Simon mentioned, there's proposal to increase this limit. But other than that, at the moment, as Simon touched on, you need to pass the work test if you're above 67 and between 74, below 67 to 74, in order to contribute to super, you need to pass that work test. Also going to be a bit careful of when your employer makes their super contributions on your behalf, just in terms of the timing of that. For example, if they don't contribute, say your June 2021 contributions until July 2021, then those contributions will go towards your limit in the 2022 year. Just bearing in mind also with this 25k limit, it's actually finally increasing up to 27,500 from 1 July 2021. Finally, after God knows how many years. And so, yeah, there's obviously some planning opportunities around this limit. And it's important to seek specific advice, first of all, because you just don't want to get it wrong. The next point is catch-up super contributions. So this is if you've got a balance less than 500,000 as at the 30th of June 2020, for example. you can make some extra contribution over and above your deductible contributions over and above your standard 25k limit for this current year. And so what that means is if you haven't utilised your 25k limits in the 2019 and the 20 year, you can actually use some of that bring forward and make a lot larger contribution in this current financial year. And that might be really helpful, for example, if you've made a capital gain, a large capital gain, and you want to try and offset some of the tax on that liability. So these unused caps from the prior year, you can draw up to 5 previous years, but the measure only started from the 2019 financial year onwards. But there's just something to bear in mind if you've got like an asset sale coming up in the next 1 to 2, 3 years, and you haven't utilised all your prior concessional cap limits the previous 5 years, well then you might be able to get like a really good tax saving there and supercharge your superannuation. Okay, cash out and recontribution strategy is the next one I wanted to cover tonight. So a bit of a large topic, I'll summarise it. So your super fund is really generally made up of 2 different components. So the first one of those is taxable components. So these components arise from, say, concessional contributions that you put in yourself or your employer on your behalf. And then the other component to your super fund is what's called the tax-free component. And this really arises from, say, non-concessional / after-tax contributions that you've made to super fund that you haven't claimed a tax deduction for. So if superannuation on your passing is paid out to what's called a super law tax dependent, which is a spouse or a financially dependent child, then there's absolutely no tax payable on any of those member entitlements that come out of your super fund. However, if your super entitlements get paid out to an adult who's adult financially independent child, then tax is payable at least at 15% on that taxable component of the fund that I was talking about. So therefore, a really useful strategy, one that we've employed for a large number of clients, is it's called this cash out and recontribution strategy. And that's in order to increase this tax-free percentage of the fund. And it has some really wonderful estate planning opportunities. And the way we do that is really making use of what's called your non-concessional limit, which is the contributions you don't get a deduction for, which currently at the moment is 100,000. And that's increasing to 110,000 from 1 July 2021. And then also as part of that, if you're below 65 at the moment, you can use your 2-year bring forward. In other words, you can place up to 300,000 worth of non-concessional contributions in this current 2021 year. And then you can't put any in for the next couple of years. And then again, from 1 July 21, that is going up to 330, that bring forward being 3 times the increased limit of the 110. You might also use the downsizer contribution if you're above 65 in order to do one of these cash out and recontribution strategies. So it's really around these 3 main ability to get money to super to use this concession. So there's a real planning opportunity, for example, if you're above 60 and you're retired, or you've ceased employment and employment activity between the ages of 60 and 65, or you're above 65, there might be an opportunity to basically take money out of the super fund. It comes out in that taxable, tax-free split currently existing within your fund, and then you go putting it back in as non-concessional contributions, etc., in order to go in as a tax-free component. And conversely, like if you've got money sitting outside of super and all your money's tied up, invested fully in the super fund, you can actually use, say, facilities from outside the super fund. Say you've got money in a mortgage offset or something like that, in order to withdraw on that money, put into super, and then take back out. I must stress, though, that do not embark on this strategy on your own, because there's a number of hoops you've got to jump through and make sure you meet all the requirements and all of that. So please don't act on this without getting any specific advice. It's a very large subject. The next point is commencing new pensions. So what we want to do here is convert as much of your super balance as possible to the tax-free account-based pension mode. And this is obviously subject to eligibility criteria. And as I said before, that's like, say, retired. And an interesting one that people don't know a lot about is if you change jobs between 60 and 65, or even if you're still working, but you take up a part-time job on the side and then you cease that part-time job, then that means you have met a condition of release and you can actually convert your superannuation to an account-based pension, subject to your available limits. The final one that I just wanted to cover is minimum pension withdrawals. So this is the final year whereby we can use the 50% COVID reduction in the minimum amount you have to take out of your pension. So it's important to check your withdrawals since 1 July 2020 and make sure you've withdrawn your minimum amount. And then next year it goes back to the full amount of the pension you'll need to take out. So look, superannuation is a very extensive topic. You know, we could spend hours on this topic as well, barely touch the surface, and there's a lot of other strategies that can be employed. But again, it's essential to get some specific advice tailored to your particular circumstances before you act, because there's some reasonably large penalties if you get it wrong. And obviously, we're happy to help out with any of that planning. Thanks, Drew. Thanks all.
Thanks very much, Mike. Very informative there on the superannuation. I'm going to take us away on the cryptocurrency side of the tax planning. And since Mike was just talking about superannuation and possibly looking at some additional deductible contributions from an asset sale, I know that there's a number of people out there who've made some profits from cryptocurrency, and that's one of the tax planning avenues you might want to consider to alleviate some of the taxes that are going to be due on those profits. So superannuation, cryptocurrency, man, I could go on about this for hours and hours. There's a lot to learn here and appreciate. So I'm just going to quickly run through really the key important things that you need to be aware of, which is firstly, when the taxable events happen, they happen when there's been a disposal event, and that's not just selling your crypto and bringing it back to dollars. That can involve crypto-to-crypto transactions, spending your crypto. You know, maybe you're lucky enough you can buy a Tesla, although I know Elon is not accepting Bitcoin anymore. It's not green enough. You might be gifting your Bitcoin or your cryptocurrencies, so that will be a taxable event. And important implications when it comes to gifting, although you're not necessarily getting anything back for the gift. From a tax point of view, the law basically says whatever that's worth at the time, that's your deemed sale proceeds, so you can actually make a gain from that. And very importantly, because I know a lot of people are dabbling in this at the moment, is putting your cryptocurrency in interest accounts can be a disposable event, and that could trigger some really unexpected taxable gains there. So be very mindful of that. When we're talking about cryptocurrency and the gains that we're making, we need to consider whether these gains are on a revenue account or in a business, or are they capital gains. So sort of really simply put, if you're just speculating, just having sort of a punt, you're in capital gains world. If you're trading, certainly with some sophistication, day trading, swing trading, arbitrage, using bots, using margin trading, futures, derivatives, that's all on the revenue side. And the big difference here is that if you're a business, you can possibly get access to some of the business deductions that are available, but you will not get the CGT discount, 50% discount, which you could have got on an investment if you held that investment for more than 12 months and then subject to any losses. So that's really important to keep in mind. Ownership and structuring. A lot of people, they start out, they make their investing, and then it's later on that they start thinking about, oh, do I have this in the right structure? So the gains that you made under the structure you've got at the moment, there's really not too much you can do at that point in time. You can't just all of a sudden throw in a trust and use a trust to minimise your tax. Unfortunately, that's not possible. But what you want to consider is actually going forward. Do I want to change my investment structure going forward? So you might not necessarily want to do that right now. Let's say come July, that might be time to think about changing over to maybe a family trust there. Volatility. This is a huge point that I want to get across because cryptocurrency prices, they go all over the place. And this is something where, unfortunately, at times we get stuck delivering some bad news, possibly. So I want everyone to really appreciate this point. So what I'm going to do is I'm going to hopefully do some drawings on the slide here. So let's say, let me get a few things out of my screen's way. Let's say we've got the tax here. Move that across. So we've got the tax here. Prices are going right up, and then they start coming down, which it's a possible reality for sure in crypto. It's happened before; it can possibly happen again. So what happens is people along the way, you're making profits as you go along. You're doing those disposal events. Everyone gets a bit excited and does a bit of crypto trading through there. And they make some realized gains. So you make some nice big gains there. Hopefully you're making some gains. Prices then start to come down, and then there's not so much activity. Maybe you only realize a little bit of losses in this year, but a significant amount of losses might be made in the next financial year. And what happens is that we've seen is that people, when they make profits in crypto, they usually reinvest in crypto. And then what can happen is, very importantly, the loss from the current year, yeah, sure, that can come off here to reduce the taxable gain. But this loss that's over here in the later year, you can't use that loss to reduce the early year gain. So what sort of can happen here is, and we want to make sure that everyone avoids this as much as possible, is that you might end up having to pay tax on those early year gains. And those sometimes can be tax owing, can occasionally be more than the value of crypto by the time you need to pay the tax, because the price of plummeted and you've reinvested in that asset that subsequently went down. The ATO is still going to want the tax dollars, so you're going to have to find some way to pay it. So it's really important, especially from a tax planning point of view. If you've got the gains, at the very least, I suggest get onto your tax return as early as possible next year, so July, August, September. Work out what tax liability you've had accrued, so then you can make some prudent, informed decisions as to how you're going to pay the tax on the profits you've made. You won't necessarily have to pay them straight away if you use MUNRO'S for the tax preparation services. As long as you're on our tax agent list by the end of October, you shouldn't have to pay the tax until March next year at the earliest. But you're going to have to find some way to pay the tax if you make profits. So good news is hopefully you make profits and you save it aside. So yeah, definitely please consider that point. I'll clear that from the screen. I think there we go. Brilliant. Okay, so the Medicare levy surcharge. I always like to make this point, which is essentially that in crypto, some people make huge gains in 1 year, and all of a sudden they go above the threshold to have to owe the Medicare levy surcharge unless they've had private health hospital insurance. So it's a consideration to go out there and possibly get private health hospital insurance to save yourself 1.5% in additional tax there. So keep that in mind. We always get this question, very popular, the disposal allocation method. Make it really simple in this case, is that, yeah, there's FIFO, first in, first out, there's LIFO, last in, first out, highest cost, first out, lowest cost, first out. So we like to use the method minimize, which basically minimize your tax as much as possible. These methods are somewhat, most of the time, available to use. There is some technicality over all this, but you generally can get away with using whichever method optimizes you the best, although you can't use average cost, that's not available. So there is some methods to be used, and also you're not locked into the method. Not only are you not locked into the method between tax years, but between cryptocurrency, you can also use different methods. So that's where a lot of our expertise comes in minimizing and taking advantage of the best methods possible for you. And the last point there is record keeping. Absolutely a must. keep good records. Keep a record of every transaction that you've got, because when there's missing information, there's a lot of extra additional work involved there, and you're going to need everything to work out everything accurately. So make sure you're maintaining your records correctly. So overall, I suppose on the cryptocurrency side of things, that's your quick overview there. What we have done is we've put together a crypto tax course, which you might want to check out. We will end up sending out the link to that course very soon. There's about 2 hours worth of content there, which will run you through not only these items, but more extensive items as well. Okay, so let's move on the slides. There we go, slides. Okay, so proactive tax planning. As part of that, we like to do smart tax plans. So this is basically this time of year in May and June. We're getting a lot of our clients and our new clients coming along. They've obviously hopefully made some profits throughout the year, but sometimes even if you've got losses, you want to do a tax estimate, work out what's your position for the year, what are the projections over the next month and a bit, understand what tax liability have you got accrued at this moment, and when is those tax payments going to be due, and then allow us as the professionals to look at your circumstances and plan around, okay, what can we do to minimize your tax now, and what can we do to minimize your tax going forward. So if you do need to seek that service, feel welcome to reach out to us, and we can certainly help. Okay, we're on to the questions. At the 1 hour mark, we're on to the questions. Brilliant, we are hitting our target. What I'm going to do is, of course, just re-mention the disclaimer for all this tax planning was that it was just general information, a bit of a guide, and that we haven't taken your personal circumstances into account, nor were we in answering these questions. So if you do need tailored advice, please reach out to us. Otherwise, you cannot rely upon this current circumstances. So what I'll do is, just before we get into the questions, what I'll do is I'll relaunch a poll. I'll relaunch this poll asking, just get some feedback along the lines of how are we doing this webinar? Are you finding the webinar fantastic? Is it pretty good? Okay, or unfortunately, if it's been a waste of time, please let us know. And then all the feedback we can get, because we want to know what are we doing well, where do we need to improve. Please let us know, because the more we know about how to help you, the better we can help you. So just end the poll there, share the results. It's fantastic to see that we've got 23% fantastic, 69% pretty good, and we've got someone who said it needs improvement. So, please reach out to us, particularly the person who let us know that we need some improvement, and let us know where do we need to improve, because we'd like to improve there. So on to the questions come on slides. There we go. All right. First one's on crypto. I'll take this one. I've been trading cryptocurrency in both leverage and spot. Would those trades be treated differently to my long-term holds, which I plan to sell for more than 12 months? Sort of the simplest answer is, yeah, they can be. You can have a shorter term trading portfolio and a longer term portfolio over here, and they can have separate tax treatments. Oftentimes, practically speaking, it can be rather difficult, especially if you use the same exchange or the same wallet, same accounts. It's really hard to then actually separate the two portfolios. So it can be done, but from the accounting point of view, it can be a bit difficult. So normally we like to plan around this in terms of structures and actually just separate the two portfolios into different entities. That can really be beneficial. All right, tax minimisation for professional owners of law firms. I believe, Mike, you wanted to have a go at answering this one.
Thanks, Drew. So, it just really depends on what structure the law firm's trading in, but I presume it's perhaps a company with family trusts hanging off of it as shareholders. So obviously trying to get as much income splitting at a family trust level on that between as many beneficiaries as you can, but bearing obviously in mind all the pitfalls that can come with that. And then in terms of whether perhaps use a bucket company, whether that's worthwhile, but also bearing in mind the Division 7A problems that Christine touched on before. At the actual company level or the law firm level, as Simon touched on, you're looking at asset pool write-offs to try and maximise your deductions there. And also things like paying your employees before the 30th of June, bonuses for employees if they've done a good job, things like that, just trying to bring as much expense as you can forward, and then perhaps look at diverting some income, if possible, if cash flow commits into a future year. Just want to make a point though, in terms of splitting income at the family trust level, that the ATO released some pretty clear guidance on that there's an expectation that the professional employee or the lawyers or the professional accountants, lawyers, etc., should remunerate themselves first at a commensurate rate for their experience, etc., before splitting income with the extended family. Thanks, Drew.
Yeah, thanks very much, Mike. Okay, let's move on to the next question. Clear up my screen here. Ways to reduce tax on a high income. How to use superannuation for tax benefits. I think part of this question we did answer throughout the webinar today. It is around the super contributions themselves, but also being aware of the Division 293 tax and possibly have to pay more tax on the contributions. And then the overall sort of goal there will be also using superannuation, the fantastic low concessional tax rates that are within super. So I think at a broad level, that's the best we can answer that question. Until we dived in and looked at more of the finer details of your circumstances, that's when we can explore more things.
About private health
So
insurance would apply as well. Yeah.
Fantastic. Rental income deductions and minimise capital gains tax for investment properties. Adam.
Yeah, I'll jump on this one. So a couple of the key things that jump to mind are it's depending on the age of the property, you can enlist the services of a quantity surveyor. So what they'll do is they'll highlight some depreciable assets and also estimate the construction cost of the property. So that'll give you some capital works deductions as well. In terms of minimising capital gains, there's not too much other than getting that 50% CGT discount. It's important to note that if you are claiming capital works deductions, that'll be reduced from the cost base of the property. But of course, if you're getting that 50% CGT discount, the effect of that will only be halved. So I'm not sure if anyone
That's the cost base of the holding costs.
Holding costs. Oh yeah.
To accumulate all those holding costs from I think 1991
Yeah.
for all the maintenance and the share rates, water rates, land tax, all those things. Sometimes we lost track, but you can always make a phone call and get a land tax assessment from a summary of all those. That comes really handy. I've used that recently.
Yeah.
And contact the council as well to get a summary of
Share
rates paid from whenever. So that works out really good.
Yeah, spot on, Christina. I think also around the capital gains tax there, I suppose, if you've already got the property, there's not much to do. Before buying the property, we will always say, look, when considering any major purchases, reach out to us and have the discussion in terms of the longer term tax planning, what structure is best here. And like sometimes people buy properties, they're originally their homes and then they rent them out at some stage as capital gains tax concessions and possibly being able to access the main residence exemption, even though it's rented for some period. And then also consider this day and age, although not at the moment with COVID, but moving around the world and possibly losing Australian tax residency, that could have huge implications on the capital gains tax there. So keep those things in mind. Thanks, Adam. I skipped one. There we go. Sole trader hints and tips on tax deductions. I'd say there is generally just having a good understanding of what's possible, the full expensing that's available at the moment. And you might be a sole trader at this stage, but like depending on the extent of your trading and your goals in the long term and whether you want to expand, are you in the right entity? So sole trader is just basically doing it yourself. whereas you could operate a trust structure or a company. Yeah, those things to consider. Otherwise, biggest tips, I suppose, is like have good records, keep good records, and keep on top of things, because a lot of times people are losing the records. They don't have enough substantiation there to claim deductions, and they otherwise just take too long to get around to do their tax return. The ATO doesn't like that, and then starts charging penalties and interest with those outcomes. Strategies in reducing tax using a company with my name. It's, I suppose, it's sort of more of a statement maybe than a question, but using a company, absolutely, you can use the company to reduce your tax. It's not necessarily the perfect optimal solution for everyone. Adding in a company, you've added extra complexity, so we've got to run through costs and benefits.
Personal services income.
Personal services income.
Sorry.
Good point, Mike. Yeah, definitely. Yeah, personal services income, and that's a whole different space when you're going into that and considering things, because with personal services, the space sort of, to put it simply, when you're getting paid for your personal labour, the tax law really tries to limit ways that you can reduce tax through, like say, using a company, and it will take away your deductions, and otherwise just go, no, you're not having those profits taxed in the company, they're going in your individual tax return, even though you might have a company structure there. But there are ways to get out of it. There's various tests they need to look through quite closely. So keep that definitely in mind and seek out our help should you need it. How to minimise tax and the incentive for small business. Who would like to take this one? Yeah. Mike, pop it in.
Yeah, so again, this is probably around the things that we've touched on previously, in terms of writing off your small business pool, your depreciable assets, superannuation, splitting income again with family members, extended family. Bringing forward deductions as much as you can, deferring income, all of those type of things, but really it's the main one this year, again, as Simon touched on, is really all those depreciation incentives that you can get. You've got the cash flow to go out and buy assets if you need an asset very shortly, then you might look at bringing forward that decision before the 30th of June. But I always say to clients, look, there's no point in going out and buying something if you don't need it, because the maximum tax deduction you're going to get is 47 cents on the dollar, but you're still spending $1. So if you don't need it, don't spend it.
Yeah, that's a huge point to get across there. People hear tax deduction, I think sometimes they think, oh, we just get every single dollar back. Not the case. So yeah, definitely worthwhile making that point, Mike, for sure. If you otherwise don't need to spend that money, why spend it? Okay, so what have we got? If you're purchasing a car in a business, what is the instant asset write-off? Simon mentioned the limit. I can't remember what it is off the top of my head. It's like
$59,136.
Oh, there we go. So there we go. One of that, and then also, do you have to sell trading your current business car? No, but there's no requirement to trade in your current car to get the deduction on a new one. This next one is very extensive questions there around cryptocurrency. I did run through quite a few of that already, and I think the best way to answer this is go ahead and purchase the crypto tax course, because I've gone ahead and addressed most of that within that course. And should you then need some tailored advice, book in a consultation with us, and we provide that tailored advice. Okay, so momentarily, we're going to address some of the questions that have come through today during the live webinar. Please keep in mind that we have been recording today's session, so as long as that's all gone perfectly well, then soon in your inbox tomorrow will be a recording of the webinar. So let me quickly run back, check out the Q&As, and then have a look at some of the questions that came through during the webinar. Christine, I have one for you. Chuck you on screen. There you go, Christine. Christine, it was during your segment, and it was with claiming employee bonuses, but not paid until after the end of the financial year. How does that work with single touch payroll?
So the employer gets the deduction basically before 30th of June, but the employee doesn't get taxed until when it's paid to them. So when it's paid to them, when it's ready to be paid, obviously, it's just recorded in the payroll software like Mayo, and then I've set it up correctly so that the correct, you've got to set it up correctly basically in your accounting payroll software to make sure that the correct withholding tax is selected, and as well as the super. So the STP reporting will be in the following financial year when you pay the bonus. So hope I've answered that question.
Yeah, you absolutely have, Christine. Thank you very much. Okay, so Q&A section. So what was the statement you said about investing the crypto in interest, which can be considered a disposal? Unfortunately, cut out when I was saying that. So basically, I was saying there's some platforms which are reasonably popular these days where you essentially put your crypto in like a term deposit and it earns interest. Oftentimes, I would say probably 99% of the time, if not 100% of the time there, putting in crypto in these term deposits, if I can call them that, is actually considered a disposal. And that means that you've got a gain or a loss on that. So if you bought, let's say you bought $1,000 of Bitcoin, now it's $5,000 worth of Bitcoin in happy days, then you put it into one of these accounts. For tax purposes, that means now you've got a realised $4,000 gain. And that's really important to know because most people wouldn't be aware of that, which is absolutely fair enough. It's not really the simplest thing in tax world, but that's certainly the case. So it's an unexpected disposal, and also on the way out of these term deposits, when you withdraw your crypto, that can also be another gain or loss that happens there. So lots to consider there. If you've been doing it, then I think you definitely need to seek some tailored tax advice there. Okay, so we've done that. So next up was best way to transition crypto holdings from personal portfolio into SMSF. Great question. Essentially, you can't just contribute crypto into a self-managed sort of fund. That's not allowed. So if you already got one, if you already got crypto and you wanted basically that wealth to be in super, you'd have to sell it down and then contribute it as money. They've got to be very aware of the caps within superannuation. Upon doing that, then once you're in superannuation, self-managed, and as long as you find the investment strategy and the rules of the super fund and the rules of super law, which is highly regulated, you can then go ahead and invest within the super fund. There was an amendment. There was an amendment to my question in terms of timing to sell out from personal portfolio over 2 tax years, June, July. I think that's sort of saying that, yeah, like you can sell down your portfolio and I suppose straddle it across June and July, and 30 June to 1 July being different tax years. That means your gains and losses they happen in different years, and that can be a way to get, say if you sold it all in June and that was otherwise going to throw you into say the 47% tax rate, and you did it over 2 years, and it reduces your tax rate to say 39 cents in the dollar, yeah, you're saving some tax there. Hope that answers your question. When will the crypto tax course be available? It's all done, just been cutting up the videos today, and we should be able to have them up hopefully the next day or two. So I imagine by the end of the week, if not early next week, it'll be available. Best advice for receiving lump sum at the end of employment, annual and long service leave to best avoid tax and increase super. Does anyone have any thoughts around this?
Yeah, it would be a matter of if you can split it out over, you might actually take it as you're going along. So yeah, you'll try and, if you can split it out over a couple of years. So often what you might do is you might say to your employer, okay, well, I'll just take some leave for the next, 4 or 5 weeks in order to put it into the next year. And that might be, particularly beneficial if you're not working next year, in terms of like splitting some of that income out into the future year. So it's really trying to play around with all rates. Again, look at using your super contributions depending on the amount of your super balance of less than 500,000, you might use some of your unused caps from the 2019 and 20 year. Yeah, it's just a matter of how flexible your employer is as well in terms of splitting those payments out.
Yeah, I suppose, and also like to make the point when it comes to your sort of annual leave and long service leave, and if you're getting near the end of your employment, if you take them, you get super on them, your compulsory super. If it just gets cashed out at the end, no compulsory super. So better off in your case as the employee to go ahead and take your leave entitlements rather than just cash them out. So that was all the Q&A questions that were submitted. Excellent. So that'll bring us to the end of the webinar here. So thanks everyone. I hope you got a lot out of the webinar. As I mentioned, you will be receiving a link to the recording, which should come across tomorrow. The webinar here today was put on by MUNRO'S, the professional problem solvers, with top 1% ranked accountants in Australia. There's a selection of our Google reviews there. 5 stars, terrific service from us. So if you do need any advice, reach out to the exceptional tax advisors here. We had Mike there, Christine and Adam, and myself, Drew. So thank you very much for coming along, and we look forward to helping you out in due course. See ya.